Welcome to Stock Talk with Nico Criticos. Today we're going to be going over 5 REIT stocks and figuring out which one is the best one to invest in. So let's take a look at the 5 I have chosen. I went through about 100 different REIT stocks, and my main motive for this was because I wanted to find a stock I could invest in that would pay at least a 5% dividend. So I picked out about 10 stocks or so, and I just kept narrowing them down until I found these 5. And so we're going to go through all the different valuation metrics and just all the things to look for to compare them. So the first one is called Medical Properties Trust. And as you can see here, the stock's trading in a higher range than it normally does over the past couple of years. So if we look at this one, it has a PE ratio of 22. Not the cheapest, especially compared to some of these other ones, but not bad for an average stock. Price to sales of 9. That one is on the higher side compared to a lot of these. Dividend yield of 5%. That's fine. That's pretty high compared to a lot of other stocks. However, the bad part here is a payout ratio of 116%, because that means they're paying out more in dividends than they actually have than they can afford. So that's not a good sign. Next one, price to free cash flow, a 19. That is high pretty much any way you look at it. And if we go to their earnings last quarter, let's see, we will find that earnings were not too bad, nothing horrible. So let's see. So that's just not a good number. Then return on capital, 3.5%. That's probably average. That's like right in the middle compared with a lot of these. And then we have revenue and EPS growth. So it's been, this 2018 number is kind of weird. I'm not sure what happened there, but besides that, the numbers are looking good there. And then we have a healthy balance sheet, which the way I describe a healthy balance sheet is really just, ideally you want like twice the amount of assets than liabilities. That's normally what I look for. But as long as there's more assets than liabilities and there's a positive equity number, then I'm happy with that. As long as they don't have debt, a bunch of debt and stuff. So that's fine. Next one, we have Prospect Capital. Okay. And if we look at this one says they engage in lending to and investing in private businesses. So Prospect Capital is trading at a lot. This one's higher than it normally trades at too. This one traded up over $9 a share, fell to 4, and now it's back to 8. So it's higher up there. But market cap of 3.6 billion, so a little bit smaller, and a PE ratio of 3.4. That is extremely low. That means it's very cheap. So also price to sales of 3.4. That's pretty cheap too. Dividend yield of 8.7%. That is very high. And especially for a payout ratio of only 31%, that's a low number. So that means very healthy there, cheap valuation. And price to free cash flow of 13, not super cheap, but cheaper than some others. And then return on capital of 13%, that is high. However, revenue and EPS growth, as we will see for Prospect Capital, is not sufficient because, as we can see here, it has been shrinking to some degree, and 2020 was a unprofitable year. These past few quarters are kind of weird, the way the earnings are all over the place. So that's not the best sign. However, they do have a healthy balance sheet. So not too bad. Cheap valuation. Seems like the company is somewhat run well. And so that one's not too bad. Next one we have up here is going to be National Health Investors. And if I remember correctly, National Health Investors is, let's take a look at this. So this one is a real estate investment trust that does sale, leaseback, joint venture, mortgage, and all these different things. Okay. So this one has been trading at, let's see, past 5 years. So this one in the past normally traded around this $70 to $80 range, and then it's dropped and it's working its way back up. So there's that. Then we have market cap of 3.1 billion, so relatively small. A PE ratio of 19, not that cheap compared to some of these other ones. Price to sales of 9.8, that is high. Dividend yield of 5%, that's average. Payout ratio of 124%, that's not good. Price to free cash flow 17, that's high. Return on capital 4.6%, that's average. Then we have check for revenue and EPS growth, as well as a healthy balance sheet. So that one's got a lot of problems because the valuation is high and the payout ratio is not good. They're paying more than they can afford. That's not good. Next one, Geo. This one I've done a lot more research on because there's been a lot of speculation on this one. So what happened with this was this company, they actually just reported earnings and they beat earnings. And this one, I do own this one. And so this one, they just beat earnings, 58 cents per share. And this one, they do they have a lot of contracts with the government, and most of their facilities are for detention centers and jails and rehab and stuff like that. So that's what they deal with. And I think what happened was at the beginning, when Joe Biden got into office, he signed a contract that said that he's not going to allow funding private prisons. Okay, so that hurt them really bad. However, I did just read in their earnings report a couple days ago that they're getting new contracts for other things. So they had a little bit of a problem there at the beginning, but then they're getting new contracts now. So, and look at the way this one trades. So this one has been on a downward move for the past 4 years now. It used to be over a $30 stock, and now it's $7. And so if we go further into this, we can see that the market cap is very small. It's only $841 million. PE ratio of 6, that is cheap. Price to sales of 0.4, that's practically nothing. Dividend yield, if you look on here, it says a dividend yield of 20%. However, that is not accurate because they actually cut their dividend at the beginning of this year in January when the news came out about Joe Biden. But when that dividend comes back, that should be nice once they get cash flow coming again. That's why payout ratio is 136%, way higher than what they can afford. Price to free cash flow is 2.7. That is very, very cheap. That's a good number. Return on capital, 5%. That one's okay. It's a little bit above, it's around average. Revenue and EPS growth, here's the problem with this company. If we look at revenue and EPS growth, we can see that it really has not been moving much. So past 4 years, they pretty much have done around this $2.2 to $2.5 billion range, and earnings have pretty much stayed the same. Actually, in 2020, they actually came down. So not the best metric there. And then health. Now here's the thing though. This is what makes this one so special. This is why I bought into this. So I put a little star next to healthy balance sheet because when I bought this, and this is still true now, but especially when I bought this and the market cap was a lot smaller. So see, I put a market cap of 840 million when it's actually 930 million now. Because when I bought it, it was 840, and they have around at least $945 million of equity in the company. So the company is actually worth more than what it's trading at right now. That's why I knew that's an easy one. That's how Benjamin Graham, the guy who mentored Warren Buffett, that was one of his original strategies, was to buy a company that had an intrinsic value worth more than what the company was trading at. So that's a super good sign. I feel very safe owning one like that. And so I think I read somewhere, if the company were to go out of business and sell off everything, it actually would be worth $10 a share intrinsically. And I've seen a lot of analysts have estimates of $12 to $15 a share for this. So I'm feeling very good for this company. Let's see what else. Healthy balance sheet. Yeah. So that one's still a buy because you're getting that one's gonna go no matter what, just because of the equity from the perspective of the equity, but they still have, they could still grow even past that. Then our last one is going to be ABR. This is Arbor Realty Trust. This is, let's see, I believe this one specializes in single family homes, multi-family homes, and let's see what the other one is. I think they do one thing. I think it's, yeah, and commercial real estate. So rental properties and commercial real estate. Okay. Market cap of 2.5 billion. That one, that's just, kind of small. PE ratio of 7, that is cheap. Price to sales of 3.7, that's in the middle. Dividend yield of 7.5%. Fantastic number there. That's a lot. Payout ratio of 50%. Key metric right there. That is very healthy. 50% that's fine. Nothing wrong with that. Price to free cash flow 2.5. That is probably below average. That's the cheapest one on here. So that's a good sign. Return on capital 3%. Not the best number, but not horrible, not terrible, but it could be better. Revenue and EPS growth, yes. If we look down here, we can see that this one's growing very fast. Revenue and earnings are both going up quick. And then we have healthy balance sheet. Yes, they do get a check for that. And so if we look this one up, this one, I believe it went IPO in... So this one has pretty much been up and away ever since it went IPO. And I want to say, let's see, when did it go IPO? Okay, I'm wrong. This one IPO'd a long time ago, never mind. But for the past 5 years, it's been up and away, besides for when COVID hit, had a huge drop, $4 a share, and then it went all the way to 18. And so I just bought this the other day at $18 a share. I only bought 40 shares just because I'm very skeptical on the way this stock chart looks over the past year. It's up 69%. And so although it's growing super fast and has a cheap valuation, it's a super healthy company, I'm kind of expecting it to fall a little bit, even if it's a 10% drop, maybe 15% drop. Kind of expecting that to happen. So when this comes back down and it's $16 a share or $14 a share, then that's when I'm going to buy it. I'll probably double my position that I have right now. But so those are the two that I bought into right now, Geo and ABR. Okay. And just based off all the research I've done, like I looked at more news and more files on this Arbor Realty Trust, they seem to be in the best position. The only thing is the stock chart has just been going up and up and up and up. So I'm kind of expecting it to fall. And when that happens, that's going to be a prime time to get into this company. But they're growing super fast. Okay, if we look at, so dividend yield of 7.8%. I'm not the biggest fan of listening to analysts and what they have to say as far as stocks go, but it is something to consider. And they have EPS growing, and they have current year, the company doing 29% revenue growth. So that's not too bad. That's pretty good. But I feel like this one is in the best position compared to all the other REIT stocks that I went through, just as far as valuation, as far as balance sheet, and as far as the growth of the company, and as far as the dividend and the payout ratio. So that is my number one pick for this list, Arbor Realty Trust. If there are any other companies that you know of that are similar in this REIT industry, comment below. I'm very interested in looking into it.